Hey everybody, Joe Sweeney here, Sweeney Michael Financial Planning. Wanted to go through our 2024 outlook in webinar form. Thanks for joining us. Going to touch on 5 major themes. We read all the 2024 outlooks so you don't have to, and pulled the most interesting kind of tidbits from them. Before we get going, I want to make sure everybody feels accurately disclosed, so feel free to pause and read the disclosures here, and then we will continue. All right, first of all, artificial intelligence was the theme in 2023. A lot of people credit it with single-handedly pulling the S&P 500 out of the bear market in 2022 as ChatGPT, of course, jumped on the scene. And the big promises being made are that this is going to be a huge cost savings for companies. It'll help a little bit with new lines of business, but essentially they're expecting it to make people more productive at work. And this is a big deal for stocks. Like they tell you at Kohl's, the more you spend, the more you save. People are expecting a lot of spend on AI in order to capture some of that productivity. They're seeing almost 60% annualized growth in business spending over the next 5 years. And it may not be a whole lot today compared to where the stock prices are in the market caps, but they think this is going to be a really meaningful driver of earnings and the bottom line over the next few years. Of course, there's been a lot of promises AI made. Some of them seem to be pretty grandiose. This is a quote from the chief operating officer at OpenAI. He's talking about what happens when we're in a post-artificial general intelligence world and it being some sort of utopian society where nobody needs money anymore. That seems to be maybe a bridge too far for me, but the real fanatics out there are expecting AI to revolutionize the world in more ways than one. Of course, as investors and in the stock market, we do have a history of getting ahead of ourselves. Here are some recent examples of market bubbles that we all lived through. The interesting thing about bubbles is that there usually is a not only a grain of truth, but a lot of truth to the promises being made. We had rare earth elements was a huge theme in 2011. These are the little pieces and metals needed to make microchips. Microchip, production has exploded over the last, 12 years, but the stocks that bubbled up in 2011, most of them have gone bankrupt over this time. 3D printing is used in a lot of industrial production at this point. Of course, those stocks, peaked and then dipped really, really quickly afterwards. And of course, you can go back and say everything that they ever promised about the internet came true. Webvan is now Instacart. Amazon has become something else, entirely. It probably took out 10 different .com businesses. And yet the stocks at the time, most of which went bankrupt because, the problem is when you make promises, if they don't come true quick enough, investors can turn their back on you. So we're kind of looking at that with AI right now, with all these grand promises out there. Are the earnings going to follow quickly enough to make it worth our while? Of course, it would be a little bit combust. You can see now average PE ratios on the Magnificent Seven. The big 7 stocks are significantly lower than they were back in 2000. Right now, you're paying about 32 times earnings. Back in 2000, at this point, we were paying almost 80 times earnings. So a lot of these companies do have very real earnings. It's just a question of whether the valuations and the PE expansion we've seen is going to come to fruition with, again, followed on earnings. Are these companies going to make enough money in the time period they promise? A lot of people ask, how can I play AI? Here's the top 10 holdings in the NASDAQ, the Qs. You don't have to overthink it. There's a lot of AI funds out there that are focused on small and mid-cap companies, but in all honesty, a lot of these companies that are dominating are the ones that have been using your user data in their research and development departments for years and years, and they're the ones innovating essentially out of their own basement. So I wouldn't expect this to be, a theme where a few different small caps come out and take down Microsoft or NVIDIA or Alphabet and their dominance. These companies just have such big moats, it's going to be really hard to dethrone them. So anyways, people ask, should I buy an AI fund? If you want exposure, just go ahead and buy the NASDAQ. You're going to get plenty, I think. Switching gears over to housing, it's been a hot topic as interest rates went up, mortgage rates went up. A lot of people have been unable to buy homes. Are prices coming down? Well, certainly Redfin and Realtor.com seem to think so. They look at the market trends. Prices seem to just continue to press upwards all the way through 2022. There's been a little bit of a back off in 23, but they're both projecting a 1 to 2% pullback in home prices. I think that you can probably reason that the pullback will be a little bit more significant than that. Here's a chart of housing affordability over the last 10 years. You'll see that the median home sale price has gone up significantly. I think there is probably a little bit more room for prices to come down. So we will see. Of course, nobody's calling for a crash here because there is just not enough inventory out there to. So we'll get into later what we think the housing price pullback will be, but a lot of that is going to depend on interest rates. People usually buy as much house as they can afford. So when their interest rates and the mortgage rate goes up, they're making less of a payment towards principal. So how much they can buy is really impacted by mortgage rates. This is going to lead us into our next section on interest rates, but we do think that probably the mortgage peak is behind us. We'll get into why we think that is. All right, there's been a lot of speculation on interest rates dropping this year. It's important to remember why the Fed moves interest rates in the first place. They do it in essence to stimulate the economy and help out the American consumer. Low rates means people can buy more, and we have a long history of buying as much as we can afford. The two major factors for interest rate moves from the Fed's perspective is unemployment levels and core inflation. Inflation has come down significantly from where it peaked a year and a half ago, and unemployment has remained incredibly low. It's below 4% now for a few years, going back to the COVID issues we had. But I think the Fed yesterday decided not to raise rates because people have a lot of income right now and the economy doesn't necessarily need more stimulus. So they're going to keep rates where they're at least for another month or two. They really want to see that inflation number get down to 2% or less. And if unemployment can stay low like it is, there's no guarantee that they'll need to even stimulate the economy. Here is a chart of the unemployment levels going back 10 years. You can see things really spiked during COVID, all the forced closures of businesses and layoffs. And then, the economy has been incredibly resilient despite high interest rates, despite inflation. And most people who want jobs have jobs, which is a good thing. So where are interest rates going? Well, the Fed sees rate cuts of 0.75% in 2024. They have a long history of being wrong and late to the game on decisions. Obviously, they kept rates too low for too long, which contributed to the inflation spike. But I think when we look at it, if the economy stays strong, they don't need to stimulate too much. So this to me seems like a pretty reasonable expectation for interest rates. There's a lot of chat every time the Fed gets together on Wall Street. People want to, obviously see rates come down so that their asset prices like bonds and stocks can go up. I would just encourage people learn to live with the rates you have. If we look at the charts, you can see rate pause periods are usually the most profitable for stocks and bonds. The Fed stopped hiking in the middle of last year, and that's when we saw in November and December a really broad rally in stocks and bond prices. And so, I don't think it's bad to live in this kind of rate pause period for a while here. And certainly the charts would suggest that that's when you make the most short-term gain. All right, on to the election. We don't have a whole lot to say here. From a market's perspective, the slow start to the year is common. You'll usually see things, bounce around quite a bit as people trying to figure out what the future looks like, especially for administration policies. And then the third and fourth quarter, there's a little bit more certainty and it's kind of a thank goodness it's over rally. But, leading up to that, there's a lot of volatility. This chart shows stock market volatility 6 months prior to an election. These are the red periods. It looks at first glance to me like The most volatile time you can be an investor is the 6 months leading up to an election. That doesn't mean change your allocation, doesn't mean get more bearish or bullish. Volatility works both ways. It can be a steep drop or a sharp increase, but just be prepared for things to bounce around a little bit more. The other thing that's kind of an interesting factor here is that we have essentially two incumbents running. Trump's policies are very well advertised, as are Biden's. There's not really an X factor or a question mark with these two guys of what the policy is going to be if either of them gets elected. People aren't super thrilled about either party, it seems like, but they both are known quantities, and there is something to be said for that. And finally, here's the financial advisor chart to put up. Try not to mix your investing and your politics. It's really difficult not to do so. But when we look over the long term, most companies have ways of making money during blue administrations and red. And that's just a simple fact. If most people are going to continue to play and work and eat and drink and travel and do all the things they love to do with their life, regardless of who's in office. All right, finally, is the consumer in trouble? You've probably seen charts like this. They talk about people drawing down excess savings, credit card balances going up. I'd encourage you to think about that relative to the time periods. There was like 3 times as much money in the economy now as there was in 2008. So it's not really fair to compare, credit card balances now versus then. And I don't think that people are necessarily running out of money as quickly as some of these doomsayers would have you believe. Here's a chart from the Fed that shows disposable income has grown significantly since 2018, 2019. And although personal savings are being drawn down, most people have jobs, going back to the unemployment chart. So, they're continuing to spend. All right, kind of heading into the close here. Can the market move higher? Here's a chart of all the market years. You see 2023 was a pretty darn good one. Stock market was up 26%. What happens after all-time highs? Well, usually you do get a few more all-time highs. There's also a catalyst here. There's a lot of money, a lot of cash on the sidelines. People who looked at money market rates at 5% and said, hey, why would I take risk? I can just go park it over here and get paid for no risk, and in CDs as well. Cash on the sidelines is up to almost $9 trillion. This is the highest in recorded history. There's probably a lot of factors here, but what a lot of market pundits would tell you is, eventually some of this money is going to go back into stocks and bonds, which of course would probably help raise their prices. And investing at all-time highs. Well, if you think about the way the stock chart goes, going back, to the beginning of when they started measuring this stuff, it's usually up and to the right. And so you're going to make a lot of all-time highs along the way. JP Morgan did some research that showed that investing at all-time highs over the next 1, 3, and 5 years from 1988 to now actually had higher expected returns than investing on any average day. And that's just because markets, when they start moving with momentum, tend to carry that momentum for a couple of years until we meet a bear market. So we've all had that experience where we're late to the party and you feel like you get burned a little bit. But with stocks, it's not necessarily the case. Just because markets made an all-time high doesn't mean that the best days are behind us. Finally, we talk a lot about dividend-paying stocks, especially for retired people. They have not moved nearly as much as the S&P 500 over the last couple of years. However, when we look at their valuations versus the overall market, you see the last time that they were this cheap really was in 2000, when tech stocks were valued at 80 times earnings, like we talked about earlier, and, normal, more blue chip companies were trading at a discount. That does mirror this time period, I think, a little bit more closely, and it's worth paying attention to. Tech stocks usually make you feel like a genius or an idiot because they tend to be so boom or bust. But for the boring companies out there that have been paying you dividends, I think it would be very reasonable to expect maybe kind of some appreciation back towards the trend line. And you would not be surprised to see dividend paying stocks outperform the rest of the growth stocks for a few years here as they play catch up. Finally, projections for the year. Here's a decent summary of a lot of Wall Street's S&P 500 targets. JP Morgan was the most bearish coming into this year, and Capital Economics the most bullish at 5,500. I think we're probably looking at something in the middle here. Obviously, these price targets most people tend to be wrong by a very wide margin. It is an interesting exercise, though, to kind of look at stock valuations today and where earnings are going and assign a price target. You never take them too seriously, but it is an interesting thought exercise anyway. So we'll throw our hat in the ring here. Here's our pure guesses. I think Fed funds rate drops about 1% from where it is now. And that would mean that mortgage rates come down probably 0.75% or 1% as well. I do think housing prices have a little bit more to pull back as people adjust to new mortgage rates of around 6 or 6.5%. And of course, the S&P 500 should be choppy, but historically in election years, the market ends the year positive. And with the momentum we have and a strong economy, good unemployment, people have jobs, they're spending money. I wouldn't overthink it too much. So I'll say that the market from this point rallies maybe 7% to 5,200 by the end of the year. Again, these are purely guesses, but you got to do it. All right. Thank you for your time. If you have any questions, feel free to give us a call, 530-487-1777, or you can email myself or Renee or Katie. It's just first name @sweeneymichael.com. Thank you.